Hi everyone, I hope you're all doing wonderful today. I'm the Portfolio Panda, the power of dollar cost averaging. Today, we'll explore an incredibly effective method called dollar cost averaging. Dollar cost averaging is a simple yet powerful technique that helps investors build wealth over time, reducing the impact of market volatility. Let's dive in. Understanding dollar cost averaging. Dollar cost averaging is an investment strategy where you regularly invest a fixed amount of money at predefined intervals, regardless of the market's ups and downs. This approach eliminates the need to time the market, which can be challenging even for experienced investors. How dollar cost averaging works. Let's look at an example to better understand how dollar cost averaging works. Meet Bryant, a smart investor who decides to invest $500 each month into a low-cost index fund. In month 1, the share price is $10, so he buys 50 shares. In month 2, the share price drops to $8, allowing him to purchase 62.5 shares. In month 3, the share price rises to $12 and he buys 41.67 shares. Advantages of dollar cost averaging. The beauty of dollar cost averaging is that it reduces the impact of short-term market fluctuations. When prices are high, your fixed investment buys fewer shares, and when prices are low, your investment buys more shares. Over time, this tends to average out, resulting in a favorable purchase price, minimizing the risk of market timing. Another advantage of dollar cost averaging is that it helps investors avoid the pitfalls of market timing. Even experienced investors struggle to predict market movements consistently. By investing a fixed amount regularly, you remove the pressure to predict the perfect time to enter the market. That brings me to my second point: time in the market versus timing the market, a wise investor's dilemma. When it comes to investing, many investors find themselves torn between two strategies: time in the market and timing the market. Let's start by defining these approaches. Time in the market refers to the strategy of staying invested in the market for an extended period, regardless of short-term fluctuations. This approach assumes that over time, the market tends to rise, and by staying invested, you can benefit from long-term growth. On the other hand, timing the market involves attempting to predict short-term market movements to buy low and sell high. Proponents of this strategy believe they can take advantage of market volatility and make substantial gains. While timing the market can seem appealing, it's important to note that successfully predicting short-term market movements is extremely challenging, even for seasoned professionals. Timing the market requires accurate predictions not only for buying at the lowest point, but also for selling at the highest point. Even experienced investors struggle to consistently time the market successfully. Research has shown that individual investors who attempt to time the market often end up buying high and selling low due to emotions and poor decision making. Now let's shift our focus to the benefits of adopting a time in the market approach. One of the key advantages of time in the market is the power of compounding. By staying invested for the long term, you allow your investments to grow and benefit from the snowball effect of compounding returns. Consider this example. Investor 1 puts $10,000 into the stock market and stays invested for 20 years, while Investor 2 tries to time the market, frequently buying and selling. Despite the ups and downs, Investor 1's portfolio consistently grows over time due to compounding, while Investor 2's portfolio suffers from frequent transaction costs and missed opportunities. In this case, time in the market triumphs over timing the market. Of course, it's important to remember that time in the market doesn't mean blindly holding onto investments without review. Regular portfolio assessments, diversification, and rebalancing can help optimize your long-term returns. By diversifying your portfolio across different asset classes and regularly rebalancing it to align with your investment goals, you can mitigate risks and increase the chances of achieving long-term success. Long-term benefits of dollar cost averaging. Dollar cost averaging is especially beneficial for long-term investors. By consistently investing over a period of years, you benefit from the compounding growth of your investments. This steady approach helps you build a diversified portfolio and navigate market cycles effectively. Dollar cost averaging and emotional investing. Emotions can often cloud our investment decisions, leading to irrational choices driven by fear or greed. Dollar cost averaging helps overcome emotional investing by providing a disciplined and systematic approach. This reduces the chances of making impulsive decisions based on short-term market fluctuations. Dollar cost averaging is a time-tested investment strategy that allows you to invest systematically, regardless of market conditions. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high, averaging out the overall purchase price. This approach minimizes the risk of market timing and helps you build wealth over the long term. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend, then tell me if I did okay at explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.